So how do you navigate this market? Well, joining us now is Hightower Advisors Chief Investment Strategist and a CNBC contributor, Stephanie Link, and Truist Wealth Co-Chief Investment Officer, Keith Lerner. It's great to have you both here on set. Welcome. Stephanie, I'm going to start with you because Rick was just talking about the weaker dollar and the fact that actually provides a tailwind for multinational companies. You were nodding your head. Is that part of the reason we've seen stocks climb this wall of worry and now flirt with new record highs?
I think we're chipping away at the wall of worry, right? We have better dealings with tariffs, for sure. We're making some progress. Geopolitics is kind of dying down for now. Inflation's coming down, and the Fed may go in September. And actually, I thought Powell sounded a little bit more dovish than I had expected this week, that they would have been cutting rates if it wasn't for tariffs. So what does that all mean, to get to answer your question? The economy is growing. Atlanta Fed tracker is running at about 3.4% for the second quarter. Average first quarter and second quarter, you're running at about 2% in the economy. That's good. Earnings, I think, are going to beat, not just because of the weak dollar, but because revenues are going to come in better than expected because the economy is better than expected. And you have the 10-year at a 6-week low. That's good for stocks. Yields are lower yields are good. And you have $7 trillion of cash on the sidelines. So you buy.
Okay. Do you buy?
Sounds like a pretty good case that Stephanie just made. I think overall the big picture is one that the market should continue to move higher. I do think that valuations may constrain on how high we go, but the big picture is we've been moving sideways for 7 months. We've had a lot of activity back and forth, but a couple of things you already mentioned I really want to highlight. One, the big T is technology, not terrorists, right? We were so focused on terrorists, but right now we're seeing the dominant theme of this bull market. Every bull market has a dominant theme, and that's AI. That's come back to the forefront. And by the way, even though the market, the S&P, is just coming back towards a new high, the technology sector already is at a new high. So that's going to hopefully bring the rest of the market up. And the other thing that's notable is, that earnings season that we had last earnings season was better than expected. But what we're really seeing in the data right now is these growth sectors, tech and communications, continue to move forward. So as Stephanie mentioned, you have some good tailwinds as far as lower interest rates, inflation, and this kind of tech theme. And technically, if you break out of this range, I think you're going to cause a bit more of a squeeze.
So is that where you would be buying, Keith? The big T, tech? You're overweight there?
We've been overweight communication services all year long. A few weeks ago, we went overweight tech. We're overweight growth as well. So we would stick with that. We're also positive on industrials if you have a little bit of some stability in the economy, but that's also an indirect AI play when you think about the power generation, the cooling side of things as well. So we like growth and we like industrials as well.
Stephanie, you and I have had conversations over the years about industrials. I think a lot of folks would be surprised to hear that industrial sector in the S&P, it's up 10% year to date. It's the top sector so far, despite tariffs and trade and macro worries and everything else.
It's absolutely amazing, but it is AI. It's data centers. It's grid. We haven't upgraded the grid in 50 years. It's power, as Keith just mentioned. But it's also aviation. Look at Boeing. They're getting their act together. GE getting their act together. Turnaround story at 3M. And then I could give you just a whole bunch of the AI infrastructure plays, too, which we've talked about. Vertiv is a recent buy for me. GE Vernova, Quanta Services, Eaton. So I like that sector. It's had a nice run. I like financials even better now, because I think the deregulation story is underestimated. We're going to get SLR changes. The exchanges are talking about reducing costs for IPOs. We went from 8,000 public companies in 1996 to 4,400 currently. That's got to change, and I think it's going to change, in addition to better M&A, better capital markets. So I think the bank earnings are going to be quite good, and the stocks are very cheap on a price-to-book basis, as well as relative to the S&P 500.
One thing I'll just add, too, when you look today, the big names, and not a recommendation per se, but you're seeing J.P. Morgan, Goldman Sachs break out. That's not the type of thing you see ahead of a big slowdown in the overall economy. So that's a positive. And I also think we're doing the reverse of what happened in 2017 with the Trump 2.0. We're seeing the tariffs hit first, but now the market's starting to focus on what they were focusing on late last year, which is the deregulation and the tariffs the tax bill that will likely get passed relatively soon as well.
All right. Lots for the market to focus on. Great to have you both here to kick off the hour.
Thanks for having me.
Keith Lerner, Stephanie Link.